Welcome to episode 43 of the Landlady Boss podcast. I'm here with my sister and co-host Rachel. Hi, Rachel. How are you doing?
Great. How are you?
I'm doing well. Today we have such an exciting guest. I can't wait to introduce him. He is a CPA and tax professional, and so he's going to really dig into the nitty-gritty of all those tax questions we have as landladies and what it means for our taxes. And his name is Preston Anderson. Hello, Preston. How are you?
Hey Marie, I'm doing phenomenal. Like it is tax season, we're rocking and rolling, it's great.
I know it's a super busy time for you. I appreciate you taking out of your crazy schedule right before taxes to meet with us all the way from South Dakota. So thank you so much. Preston has been doing taxes for 22 years. This is your 22nd tax season. How does that feel?
I didn't realize I'm getting old until I say that.
You're not old. You're not old.
No,
But I bet
not
tax
at all.
season feels like it ages you probably.
A little bit. This tax season's probably aged me less than any others. I have two employees that are, I feel like I've been doing taxes longer than they've been alive. But,
Oh my
uh,
goodness.
but yeah, so they're working on their CPAs too. So
Preston Anderson is a CPA and founder of Anderson Tax, where he helps business owners keep more of their hard-earned money through strategic tax planning and financial guidance. So we are so excited to have you today, and we cannot wait to learn from your expertise, Preston.
yeah, you're I mean we've been friends for what, 3-4 years now.
Yep, yep.
So yeah, this
So
is
a few
fun.
years. Preston has experience with real estate taxes, and I would call you more a strategic tax planner, not just an accountant,
Yeah.
because you like to be strategic, which I think is so hard to find nowadays when you're shopping around for accountants. So I love that you use the strategies and find ways to keep more of your money.
Yeah, so like the first 10 years of my career, I worked at a mill where you couldn't do strategy. We were just too busy to where I was doing 1,300 returns a year by myself, and you don't
Wow.
have the time to stop and think about people's situations. And
Mhm.
so today we have much fewer clients, but instead of just getting them in, getting them out, getting them as fast as we can, we take our time and we literally try to go through every single person's situation, fully understand it, and then create strategy that's specifically designed for that person. So it's
That's
a little
fantastic.
different mindset and approach than it used to be.
Yeah, I bet that's a little less stressful. So, and having that personal touch. So I think let's get started. What are some of the most common tax mistakes landlords make when filing their returns? What do you see about them?
Bad books. Okay. Having bad books is honestly the biggest mistake. So I would say it's two. It's one is record keeping is like so incredibly important. And then commingling. Like, good heavens, when people commingle and they use one account for their personal stuff, they use one account for their business stuff, um, that is the worst thing you can possibly do. And it makes tax time so much more stressful than it ever really needs to be. Whereas if you just keep things separate, you don't commingle, and you keep good books, tax time can be a breeze. That's honestly the biggest mistake. Like, I'm redoing a person's return right now from last year where he had bad books. He didn't realize he had personal accounts attached to his QuickBooks. And at first, it's like you pull a string and all of a sudden the whole sweater unravels. Um,
Oh no.
and like we're just finding mistake after mistake after mistake in his books, and like he did them himself, so we can't blame another bookkeeper. But first and foremost, like create a brick wall between you and your business, or you and your properties, you and your entities, and and then keep things separate.
That's really good advice. Well, and especially if you are not having good numbers, then how are your taxes going to turn out right if the numbers aren't right? That's a big problem.
Can you walk us
What
through
are,
the key tax deductions that landlords should be aware of when managing rental properties?
yeah, so any time you have expenses that are related to the business, you can
Hmm.
deduct them as long as they are ordinary and necessary. And so a lot of times you're going to see for landlords we see a lot of mileage. We take their cell phones. We take all of those kind of like ordinary expenses that you see kind of every day.
Wi-Fi and the things to run a business.
Yeah.
Yeah.
Yeah, so we often try to take things that they're paying for personally anyway, and we try to pull them into the business, and we do it with full-on business purpose. The business needs you to have those things. And so we try to take as much lifestyle into the business as possible. Um, and then once we do that, then we try to, after we do kind of those normal things, we try to go into some of the more kind of call it extracurricular. Okay. If your kids are helping you, so like when I was young, my mom owned a bunch of rental properties, and I helped her with those properties, and so she paid me when I was young. And so like when I have my kids in my business, I find ways to pay them, and there's ways to do it where it's 100% tax free, money going out to your kids. And so there's all sorts of ways to kind of get money out and pull it and make those dollars tax free. And that's where people, so I guess there's the easy, common, low hanging fruit stuff, but then there's kind of the more difficult, and that's where it gets more fun, is you get to do a little more planning, a little more strategic ways to think about your.
I can just see in your countenance, Preston. If you can't see us, go on our YouTube channel and you can watch the video footage. But Preston he's like beaming like a kid. He's all excited about taxes. That's really unique.
Yeah.
My thing is, I don't like paying taxes at all. I hate paying taxes. And so anytime I can find ways to make things tax free or to create tax free wealth, like, oh my gosh, that's where I get giddy. Personally, I don't think the government spends our money very wisely. And so it's like I want to give them as little of it as possible, as legally possible. But so I get giddy when I get to help people save money. That's when I get giddy.
Do you run the children's payment through a payroll, or do you run it as a 1099?
It is W-2, but the way we do it, there's no taxes on it. And so there's no Social Security, no Medicare. So they get W-2s, but there's no taxes. So it doesn't go through a payroll company, but it does go through payroll.
And do you just need to keep documentation throughout the year of what your children do? And I mean, they obviously have to be doing work for you.
Yeah, of course. Yeah. So yeah, what you have to do is document. The old saying is everything is deductible until you're audited, right? And so what you want to do is you want to document so that, yes, you are legitimately hiring them for a business purpose and that they are helping the business. But then document their hours, document what they actually did. And in doing so, when you give them the W-2 at the end of the year, not a 1099, those payments are federal tax free, Social Security, and Medicare tax free. So all the employment taxes, there's literally nothing on them.
And they've just recently changed the amount that you can pay them, the cap, isn't it? Now 14,000 or
for 25, it's 15,000.
Oh, 15,000.
Yeah,
okay.
It's $15,000. And so what you can do with that money, I help my kids invest it. Okay. And so it's basically building up their college fund or their first home fund, or their first business fund that we're putting $7,000 into their Roth IRA because it's earned income for retirement. And then the other money goes toward their college, their business, their home fund. And so when they turn 18, they'll have a chunk of dollars that sits there for that first big purchase or the first business.
I have another question, follow up on that one. So let's say, what is the age that drops off? Is it 18, or is it when you stop having them as a dependent?
It is 17. So you can hire them tax-free up until they're 17. The day they turn 18, it stops. You can't pay them 100% tax-free. There are still a couple of taxes that aren't applied until they turn 21. But the cool thing is you can actually do this with a parent as well. So I have some clients where they pay their parents on W-2. And so until they turn 18, but then it happens again once they turn 65. And so we have clients that they then hire their parents back when they get older.
Oh my gosh, that's great.
Oh, that's great.
I love it.
And then what they're doing with the parents is they're taking that money and putting it into the Roth IRA as well. And then they're being named the beneficiaries of that Roth IRA. And so it's essentially a way to get more money into a tax-free bucket.
That's
But the parents are
fantastic.
legitimately doing work. They're legitimately doing the work. They're documenting it. It's all, you keep it all above board and all legitimate, but yeah.
What a great way. I know we have, both of us, Rachel and I, have used our kids in our businesses cleaning and painting and landscaping, anything that we can find for them to do. And it's a great way for them to learn life skills, but also earn it. But as you're saying, be able to invest tax-free and it's a really fantastic way to utilize your business.
Yeah. I did all those things for my mom. My mom owns a lot of real estate. And so when I was in high school, she would buy hoarders' homes. And so I would clean out hoarders' homes a lot.
Oh my gosh. Nice.
But it was a way for like me to make some money, but me to also, I was always working. I was always doing something for her. So I actually did some handyman work for a couple of years, but that's something I stuck with.
What are some other write-offs that people don't necessarily know about that they should be doing with rental properties?
So I would say one that is, and we'll kind of touch on this a little bit as well, is cost segregation studies. So cost seg studies, it's accelerating your depreciation. So things like when you buy a home, and it depends on your situation. Sometimes it makes a ton of sense. Sometimes it doesn't. But if you going to have a large tax bill, especially using certain strategies, using a cost seg, you can pull out a boatload of depreciation in a single year and really drive your tax bill down. So that's one I don't see a lot. I also want my clients to be careful with it and use it when appropriate. I had a client that came in, they had a cost seg study from a previous accountant, and he drove their income down about $100,000, which in a normal year would be good. The problem was her AGI ended up at like 30 grand, and they had $100,000 capital gain that year. And so had they not had the full depreciation, they wouldn't have paid any tax because they would have been within that 0% capital gains rate. So the cost seg study cost them $100,000 of depreciation that they pushed forward, and they only saved at the end of the day about $600 in tax. And so it's cost segs are one that I see as really, really, really beneficial in the right situations, but you want to be careful as to when and how you use them.
So Preston, what are the tax implications of selling a rental property? Are there any strategies landlords can use to minimize the capital gains tax?
Yeah, for sure. So when you sell a property, you're going to have two separate taxes. You're going to have capital gains. So if you bought a property for, say, $200,000 and you sell it for $300,000, that $100,000 is going to be taxed at capital gains. You're going to have a second tax because you're depreciating property over time. If you depreciate that property down to, say, $150,000 and you have $50,000 of depreciation that you've taken, you have a second tax called recapture. And so your income isn't just from what you bought it to what you sell it for, but you have to actually pay back all of the depreciation, pay taxes on it. And so it's one thing that we want to be cognizant of. So I had a client a few years ago where they had a property that was two separate parcels, and timing is everything with selling property. And their income was low enough where they didn't actually have a lot of other income, and so when they sold the property, it was going to push their income to like 200 grand, and I think that we worked it out. It was going to cost them about $20,000 in tax. By pushing off the one property to the following year. And literally it was 7 days because they sold one property in like December 26th or 8th or something. And the next property like January 3rd. By separating it out by years, it literally saved them 20 grand, $15,000 or $20,000. And they didn't have to pay a penny in income tax because they were under those thresholds of the 0% capital gains rates. And so you want to be cognizant of all of the things, not just, a lot of people think when they sell a property, they're just going to pay it on that gains. But if they've depreciated it down to zero, they're paying it on the full amount. And so, there are some ways to reduce that. Things like 1031 exchange, where you actually go out and identify another property and then basically roll all of the gains into a separate property. That's one way. Doing a thing like the cost seg, where you buy another property and then do a cost seg on it. With a cost seg, there's kind of fewer restrictions on how you can depreciate the property. Let me rephrase. With like a 1031, there's a lot of restrictions on how you can use that money, and you have to buy a property you have to roll over all of the funds completely, and have as big of a loan if you had a loan on it. You can't really
Within a
take it in
certain amount of
cash.
time. Yeah.
Yeah,
Right.
there's all of those little restrictions. Where with a cost seg, you just go out and buy another property, do a cost seg, and you can really hammer your depreciation down a lot in that year. And especially if you have like other things where it's a short-term rental where there's no losses or no limit on losses, or you're a real estate professional or something of that nature, then you can really drive that income down in a single year.
Nice.
That does bring up a good point. You
Yeah.
mentioned real estate professional. Can you kind of go into what qualifies a person as a real estate professional and how that's beneficial to you for your tax burden?
Yeah, for sure. So there's only two real qualifications for a real estate professional. One is you have to spend 750 hours a year on real estate activities. Okay. And then the second is that has to be your number one use of time for business. So you can't have a job where you're working 2,000 hours a year and then work 750 on the side and get the real estate professional status. It has to be your number one job. And so I see a lot of entrepreneurs and physicians where what they will do is they work their job, they use their money to go buy real estate, and then their spouse gets that real estate professional status. And so you don't have to be a licensed real estate agent to get it, which is a big misconception. A lot of people think, oh, I need to go take classes and become a licensed professional to get the real estate professional status. And that's not a part. It's like I said, it's only the two. Getting your license is not one of those two. And what it does is it essentially opens up for unlimited losses. Now, you don't want to lose money on your projects. You don't want to lose money on your deals. But there's a difference between tax losses and actual losses. And real estate, using like appreciation and inflation, is one of those beautiful areas where you can essentially show a tax loss at the same time of showing a cash gain. And so I've seen plenty of people do it where they are able to cash flow while still showing massive losses, and using that real estate professional status, the losses are unlimited and it goes against all of your other ordinary income. So it's a fun one. It's not hard to do, but you want to document. If you're going to get that 750 hours, you have to document how you got it. If you're in the process of like flipping homes or doing lots and lots and lots of real estate, it's often really, really easy to show. If you're not, then you want to document. If you only have a handful of rentals, you want to document how you got to that 750.
It's such an amazing way because, yeah, you can, like you're saying, you can have a one spouse or partner that's, earning at a normal job and earning the income, and then the other one is working the real estate side and having that real estate professional status, and then they can use all of those depreciation and losses and write-offs against their personal taxes. Oh, yeah. It's amazing. So that's a fantastic way.
Yeah. And what's really cool about real estate is oftentimes people will put down a percentage of, they're not putting down 100%, right? They're not buying properties all in cash. They're putting down 20% or 30% on rentals. When you do some of those cost seg studies and some of those accelerated depreciation, you can actually get a bigger deduction in that first year than you put down in cash. And it's not necessarily that you've created like a massive cash loss, but you've created a tax loss where you're able to depreciate more than what you actually have in cash in the property.
Does that work? Yeah, if you convert the home that you're living in into a rental, so you're in a single family home, let's say you go to rent it out, can you then have that as the investment and it changes its status and then becomes something as a depreciable investment versus your home?
Yeah, so the second you start to rent it out, you place it in service. And how that works is whatever you paid for it plus like increases to basis. So if you redid improvements on the property, if you added an addition, those will add to basis, and that becomes your depreciable basis that you get to then start depreciating from. But it starts the day you start to rent it out. Yeah, plenty of people will be in a home that they live in, and we'll convert it to a rental and start to depreciate it. What you want to be aware of, though, is if you live in a house for 2 out of 5 years, the gains are all tax-free. And so what I see a lot of people do is they'll turn it into a rental, and then before that 3 years hits, so 2 out of the past 5 years they lived in it, they will then sell it, and all of the gains are then tax-free.
That's a really great way to not have to pay all those taxes on any equity that you have in the house. Could you talk to us about upgrades versus repairs? Like how the difference tax-wise? I mean, because you say, you get a rental property and then you put it into service. Well, is there a difference between if it had been rented and then you do, say, repairs versus buying it, doing upgrades, and then putting it in service? Does that make sense?
Yeah, for sure. So sometimes you'll see hotels where they have a grand opening. They'll be under new ownership. They'll have a grand opening and then they'll close for 18 months. Have you guys ever seen anything like that?
Yeah.
Okay.
No, that's bizarre.
Yeah, it is. It is. The reason is for taxes. Okay. So if they were to buy the place, close it immediately, and then go into repairs, all of that repairs and all of those additions and things that they're doing add to basis because it hasn't been placed in service yet. And so what they do is they have one night where they place it in service, it's placed in service, and then all of those repairs become expenses, not additions to your basis. Okay, and then they can write them off in those years. Okay.
Wow.
And so
Amazing.
I've had a lot of clients do this where they will buy a property that they Airbnb. The day they get it, they rent it out for literally one night, and then they turn it off, they close it, and they go into like upgrade modes, and they make it all repairs. So there's a difference between repairs and improvements. Getting a property back up to serviceable is a repair. Making the property better is an improvement. Okay. So for example, if you replace a roof or you replace a water heater versus putting in an addition. One would be repair, you get to write it off in the current year. An addition, where you're making the property better, those you're going to capitalize and depreciate over time.
So I'm hearing this, the key is you want to rent it, at least for a night, no matter what.
Yeah, put it in service before you go into the massive repairs and the massive upgrades of the property, renovations.
You mentioned short-term. Right, that it's an investment property. So short-term versus long-term, how does the tax treatment differ from the revenue received from long-term revenue versus short-term rentals? And then what should we know as landlords, landladies, about reporting the sources of this income and how do we report it?
Okay, so Airbnb there's this like Airbnb short-term rental loophole right now, where you don't have to qualify as a real estate professional to qualify for this short-term rental unlimited losses. And so where I see a lot of couples where the real estate professional, where one spouse is working and the other is not, works really well for that other spouse getting the real estate professional. Where both spouses are working, where one spouse is a doctor. I have like a client who one spouse is a physician and the other spouse works in tech, where they're both high W-2s. Neither of them are going to qualify for real estate professional. It's not possible.
Right.
Where now they use these short-term rentals, and as long as it's rented for on average less than 7 days, all of those losses then become unlocked. And then they get to do all the same things as if they were real estate professionals, because there's this little tiny loophole where you can deduct losses against your Airbnbs, and they're unlimited.
It's brilliant.
Yeah, the thing you want to be careful though is you don't want to actually lose money. When I see so many people, they're like, "Oh, we're going to create losses for tax purposes," and then it's like, no. Don't actually like create cash losses. Create losses, yes, but like we want them to be tax losses, not actual cash. Like if you're buying properties that are not going to appreciate and you're not going to be able to make money on, and you're just doing it for the depreciation and for the losses, bad strategy. You want to find properties that will appreciate, that you can do all of this stuff with, but that at the end of the day, the goal is to make as much money as possible, right?
Right.
Let me clean up the tax mess on the backside and like help you with it, but like The goal is make as much money as possible, which is something that I see some accountants do so backwards. I have a client where her previous accountant told her to go buy a depreciating asset, and it was $400,000. She wrote the entire thing off in the first year. It never cash flowed. And she's like, oh, I got this massive tax benefit, but she still owes the $400,000 on loans. And I'm like, oh,
You're not ahead.
You're not ahead. Like, yes, you saved $100,000 or 130 grand in taxes that one year, but now you still owe $400,000 on this loan. The thing is not appreciating, it's devaluing. And it's like, yeah, we want to do things smart when we go after some of those losses.
Absolutely. You don't want a bad deal just to try to save some in taxes. That's gonna, at the end of the day, then you're still left with the bad deal.
Exactly. 100%.
Oh my goodness. Well, when people are setting up these rental properties, what strategies would you give for the legal entities? Do you do a LLC or a S corp?
So you never want to put real estate inside of an S corp. Like, that's just a big no-no. I shouldn't say never. The answer is not never. It's almost never.
Almost never.
It's rarely. It's very, very, very rare. I can't say never because I've seen it work and I've seen it like be a good thing. And so, but we'll just say never for this purpose.
Okay.
So with your real estate, generally what you're going to want to do is you want to keep your real estate inside of an LLC, and that's for legal purposes. It's not actually for tax purposes. LLC is a limited liability company, and what it does is it allows the liability of that property to stay within the LLC. And so I have seen people do, I think famously, Ted Turner owned a ski mountain, and every single parcel of land pin, like each parcel had its own pin on the entire mountain, and every single pin was its own LLC. And then every door inside of his hotel was a new LLC. Okay. And so they were all like completely separate LLCs. Now that's not to say that they filed 7,000 tax returns, but like they all probably filed one tax return that was held by another entity, but it's for liability purposes. It's not for necessarily tax purposes.
So they can only sue one pin, only sue one door. So,
right.
Yeah.
So they can take that one door and then that's it. Like they're not getting the whole hotel.
Lose the mountain.
Yeah.
Oh my gosh,
yeah.
That's funny.
So yeah, it's properties go inside of LLCs. If you're going to do active work, that generally goes into like an S corp, either an S corp or a Schedule C, kind of depending on the other strategies that are going to go into your specific situation. There is no general advice, unfortunately, just because everybody has their own specific, unique circumstances. Like I'm a CPA, but I'm not Marie. I'm yours, but I'm not all of your audiences, right? And so.
Right.
Like the advice I'm giving, it's fairly general, but there is no like one size fits all, unfortunately.
How about when is an S corp a benefit? Like when would that be a benefit to have an S corp?
Yeah, so the big benefit of S corps with real estate is when you're doing a lot of property management, and you're actually turning a decent sized profit with it. I see S corps work really, really, really well with real estate agents, where their real estate agent income is going through the S corp. Also, where people are doing property management for not necessarily for their own properties, sometimes, not always, but a lot of times when they're doing property management for other people. Those are generally the two times I see it the most beneficial for real estate professionals, but not holding their real estate in it. They want to hold their real estate outside.
And in my situation, I know that you have strategized for us. Yes, full disclosure, Preston is my CPA, so he's always giving me different strategies with my rental properties. But, he had us do a property management LLC to oversee the management of the different properties, but the properties are in their own LLCs too. So it's just kind of a strategy that you had us do.
LLC is where we follow the kids through and do some other fun strategies.
Yes. So like you're saying, every situation's different. Obviously, you're trying to give broad advice for the populace, but check with your
Right.
own CPA or give Preston a call if you want a more personalized strategy for your own situation.
Yeah, I think most of us are landladies are property managing out of our home. So I think that comes up a lot. What can you write off from a home office and using your car, etc.?
So home office is a fun one. I can actually give you guys a worksheet. So if people want to download it, they can have it for free. It's like my home office deduction worksheet.
That'd be
I'd love
fantastic.
that.
I can put it in the show notes.
Yeah, perfect.
Mhm.
But what you can do is if you have a dedicated space of your home is for an office, then you get to write off every expense for the house. Okay, you get to write off your mortgage interest, your real estate taxes, your landscaper, your cleaning, all of the repairs, maintenance, everything that goes into the house. You get to write off a percentage of it for that home office. And so oftentimes we'll have that separate like property management company where it's active. And then that home office expenses goes against the property management company. And then same with your car. When you have a home office, what's really cool is there is no commuting miles. And so when you have a home office, you drive from your office, which starts at your door, and that's mile one is a business mile. So anytime you drive for work to properties, those are all deductible. I honestly suggest often using an app for your miles. It's honestly the easiest. Mile IQ is really good. QuickBooks Online has like a mileage feature. Not as good. Don't recommend that one as much. But Mile IQ, it's like $50 a year or something like that, $60 a year, where you can get it tracks 100% of your miles. Personally, I use Google. I just track it on Google tracks me. Google knows where I am. They stop me.
It knows where you are at all times.
Yeah.
How do you handle your rental income if you're using the property for both personal and rental use? Is that a trick question?
Talking like a vacation home, or are you talking like a part of your main home where you rent out like a room in the house?
I think a vacation home, like you use it for personal use, but then you also rent it out. So like a short-term
Got it.
rental.
Yeah. So
Does that get tricky?
It does. Yeah, for sure. So when you have like a vacation property that you're renting out to other people, what you're going to want to do is track meticulously the days that other people use it and the days that you use it. And so oftentimes having other people, it's fairly simple because an app like Airbnb will tell you the days. It's very simple. But you still have to track how many days you use it. And so you're going to want to find some type of tracking, just have some sort of system where you know exactly how many days you used it. If you personally use it less than 14 days a year, then it's as if you didn't use it at all for personal use. Okay, 14 days is a magical number in the tax code, especially when it comes to real estate. If you use it for less than 14 days, then it's as if you didn't use it at all, and then everything is deductible. Okay, it's just like any normal rental property. The second you use it more than 14 days, you have to partition how much was rental and how much was personal. And so all of a sudden, it switches from being able to deduct like all of this stuff to very little. So I've seen people really kind of get messed up when they use it more than 14 days. So if it's a rental property that you're like wanting to use mostly as rental, then try to stick to that 14 days and then just be done at 14. But if you want to use it a lot more, then just track.
What if it's working vacations and you're painting and landscaping? You're just working the whole time you're there.
It's not personal use.
Perfect. So you just need a working vacation home, but that sounds awful. Defeats the whole purpose of a vacation.
I think that defeats the purpose of a vacation.
That's like a losing house that you bought to offset the taxes. Right. Same kind of thing.
Marie found a losing loophole. She can ruin a vacation.
Yeah, how was your vacation? I don't know. I painted and weeded the whole time. It was awful.
It was great.
Yeah, but leave it to me to ruin a vacation.
How many days you use? It'd be the amount of days you black out on Airbnb, because you can black out the days that it's not available, and those could be the days that you use. So that's the easy way to track it.
Through the built-in calendar there. That's a good idea.
Yes.
People will use like both Airbnb and Vrbo.
That could get tricky.
I don't know if those like black out. If it's booked on Vrbo, does it like black it out on Airbnb?
Yeah, they do
I think they
overlap.
sync up.
They coordinate, yeah. And there are
Okay.
third parties that coordinate all of them, so you could do that. But yeah,
Okay,
or
cool.
you just keep two calendars, but they do coordinate. Yeah. So there's just so many questions, and I know that like we are taking your time, and we appreciate all of this information. I think taxes would probably be what most people dread about running their own business. And I love the things that you've laid out because you obviously don't dread it. This is something that you like doing. But for property managing, I mean, we could be amazing property managers and pick great colors and have these amazing rentals and good tenants. And then it comes to bookkeeping. And that is, I think, a lot of people's weak point. So this is good.
Oh, yeah, I would not disagree at all. I've
True
seen,
statement.
um, I've seen way too many. I've worked with loads and loads and loads of real estate agents and loads of real estate investors. Yeah, it's not people's favorite thing to do. It's like they want to be in real estate. They don't want to be sitting down and keeping books. So yeah, no, it's not. I think I've seen the messiest books with people who run real estate. Just because.
Are you talking about me? Full disclosure, this is me. You can say it, I guess.
Big ball of yarn we had to unwind when we started working together. Now it's mostly good, mostly easy.
I'm going to say the accountant I had before Preston was not familiar with real estate, and it was a disaster. So Preston had a little bit of work kind of figuring out that whole mess.
Yeah, it was just a ball of yarn. So you remember those like headphones you used to put in your pocket and you pull out the pocket? Like you pull out your pocket, the headphones, and you have to like undo the headphones?
Yep.
That's what your situation felt like.
Yeah, we're in a good place. We're in a much better place now. Due to Preston.
Oh, that's
Yeah.
good.
I wasn't actually thinking about you. To be honest, I was thinking about my mom.
It's okay. It's okay. Your mom was a mess. She's not listening. It's okay.
My mom used to come to my house every August and for a month would sit with me for 2 hours a night and bring pizza every night. And I was like, if I'm going to work on your stuff, I'm doing it for free. So you got to bring pizza and you got to sit with me. So over about a month or 2 month period, we would sit for about, give or take, anywhere between 75 and 100 hours working on her books and figuring things out.
Oh my gosh.
Ouch. That's bonding time.
Yeah. Oh yeah.
That's a good son. What a good son. My kids better, go into a field that I need, a professional field that I need. I'd appreciate that.
Hearing them. You're like, and you will be my accountant, and you will be my lawyer.
Yes, what else do I need? Well, Preston, this is such awesome stuff. Thank you so much. Just as tons of information packed in here and all these questions. And I think that's why people don't like doing taxes, because just as you've been saying, all these little details and loopholes, and this is not written for ease at all. So
it's all written down. Nobody wants to read 60,000 pages.
It's not an easy read either. It's not fun. No one wants to study it, at least almost no one. No. I guess you do.
See, I read books like this for fun. Actually, this is not true, but like this is the tax code. I don't read it for fun, but I read these things. These books aren't all for show.
Yeah, right. That's just your set for the channel, right. The YouTube videos behind you.
Yeah, what does your poster say behind you?
The person at the top of the mountain didn't fall there.
Nice.
Oh, I love that.
So I have another one coming that I'm replacing that out this week. Basically about being your most authentic self and attracting who you're going to attract. So it's a fun one.
Love it.
Well, thank you so much for meeting with us, letting us learn from you. Any last minute tips or advice for this tax season?
My biggest tax advice with most people is don't be so afraid of taxes and paying tax that you stop yourself from making money. Okay. I see way too many people that get so emotionally distraught when they think about taxes that they convince themselves that it would be better to not make the extra dollars than to pay the tax. And my philosophy is make as much as possible and then let people like me deal with it on the back end. Elon Musk paid $12 billion in tax a couple of years ago. more than anyone in the history of the world in a single check. Okay. And yet he did so because he got to keep something to the tune of like $35 billion in cash after tax. And so, like, just don't be so afraid of taxes that you hinder your opportunities going forward. That's all.
So true. That's so true.
Good advice.
It's like
Good.
cutting off your nose to spite your face. I didn't pay taxes, but I'm broke. Like, it's not a good look.
Noseless.
Noseless. Exactly. Well, Preston, if people are interested in reaching out to you and connecting with you, how can they get a hold of you?
So anderson.tax/schedule is the easiest way to get on my calendar. The website is not very good, so just go to the calendar.
Okay, I'll put that in the show notes if you want to reach out to Preston and maybe do a call.
That document as well, the Excel.
Yes,
perfect. And I'll put that in the show notes too. Thank you so much. This has been a wonderful, informative time.
Super
and
helpful.
Don't freak out the next couple of weeks. Try to relax, take some breaks if you're so stressed about your taxes, and just realize this too will pass. If you have any questions or topic ideas, feel free to email us at landladybosses@gmail.com. We love hearing from you, and connect with us on our Instagram and Facebook at landladyboss. And we also have landladyboss.com if you would like more courses or templates or documents to help you manage your properties better. And remember, no one manages your properties as well as you.